Imagine your favorite local coffee shop, let's call it Morning Brew. It makes the best coffee in town. The owner, Sarah, has a dream to expand. She wants to open shops in every city, but opening new shops costs a lot of money. Sarah has a great business, but she does not have millions of dollars sitting in the bank. So she decides to sell small pieces of her company to raise that money. Each tiny piece is called a stock. A stock is simply a share of ownership in a company. Owning a stock means you own a small fraction of everything the company has. Its brand. Owning a stock means you own a small fraction of everything the company has. Its coffee machines. Owning a stock means you own a small fraction of everything the company has in Napper. Its future profits. It is a claim on the company's success. The stock market is the place where these tiny pieces are bought and sold. Think of it less like a complicated financial system, and more like a giant, bustling farmer's market. Instead of fruits and vegetables, people are trading ownership in companies like Morning Brew. You should care because the stock market is one of the most effective tools for building wealth. Every big company you know, Apple, Amazon, Coca-Cola, started as a private idea. At first, a company like our fictional Morning Brew is owned entirely by its founder, Sarah, and maybe a few early investors. It is a private entity. Decisions are made by a small group and ownership isn't available to the public. It needs money to build new factories, hire more employees, open hundreds of new coffee shops. This is when a company might decide to go public. Private company, public stock, public stock market. This transition happens through an initial public offering, or IPO. Think of it as the company's grand debut. The company works with investment banks to value the business and set a price for shares. For the very first time, it offers shares to the public. Investors, large institutions, individuals like you, can buy a piece of the company. The money from this initial sale goes directly to the company, giving it fuel to grow. Once the IPO is complete, the stock begins trading on a stock exchange. An exchange is an organized market where shares are bought and sold continuously. The company is no longer involved in daily trades. Shares are passed between investors. One early buyer might sell a year later to another buyer. Price is no longer set by the company. It's the push and pull of buyers and sellers. This makes a stock a liquid asset. Liquidity means you can convert your ownership back into cash with relative ease. In a private company, finding a buyer could take months or years. You'd negotiate directly. Public stocks trade with millions of participants, so you can sell in seconds. That ease of trading is a cornerstone of the modern stock market, allowing capital to flow to where it's most valued. At its core, every single stock trade is a simple agreement between two people, a buyer and a seller. The buyer is betting the stock's future is brighter than its current price suggests. They are optimistic. They see potential to grow, to increase its profits, for their share of ownership, to become more valuable. The seller, on the other hand, has a different perspective. They might believe the stock is overvalued or need cash, buying a house, paying for college, rebalancing investments. It's not always a vote of no confidence. This constant dance between buyers and sellers is what sets the price. Imagine an auction. Many buyers, one painting. Price goes up. Many sellers, few buyers. Price goes down. The price you see is the last completed trade, where buyer and seller agreed. To join the dance, you place an order. No shouting on trading floors. You use a broker app or website. Two basic orders, market order and a limit order. Market order. A marker, buy or sell now at the best available price. It prioritizes speed. Limit order. Omar only buy at $50 or sell at $60. It prioritizes price over speed. These orders translate intentions into market activity. Millions of orders per second. A student buying their first share. A giant pension fund selling 1 million shares. Their orders interact. This global conversation creates the fluctuating prices on our screens. A beautiful, chaotic, deeply human process of discovering value. While the concept of buyers and sellers is simple, the machinery that connects them is incredibly sophisticated. The most visible parts of this machine are the stock exchanges. New York Stock Exchange, with its iconic trading floor, NASDAQ, a fully electronic exchange, and home to many big tech companies. Today, most trading happens silently and instantly on powerful computer servers that match buy and sell orders in fractions of a second. Your personal entry point into this machinery is through a broker. A broker is a company that is licensed to execute trades on your behalf. Think of them as your agent. Phone, broker, exchange. In the past, this was an expensive service. But technology has changed everything. Today, online brokerage firms allow you to open an account with very little money and often charge zero commission for trades. Behind the scenes, there is another crucial player, the market maker. These firms stand ready to buy and sell, provide liquidity, and earn the bid-ask spread, the small difference between bid and ask. Their presence keeps the market running smoothly. A stock's price moves for one simple reason, a change in the balance of supply and demand. Supply refers to the number of shares available for sale. Demand refers to the number of shares people want to buy. When demand outstrips supply, more buyers than sellers, the price is pushed upward. When supply exceeds demand, more sellers than buyers, the price is pushed downward. This is the fundamental heartbeat of the market. Every news headline, every earnings report, every new product launch is filtered through this simple lens. Will this make more people want to buy the stock or sell it? What drives these shifts? In the short term, it is often news and emotion. A surprisingly good earnings report for our Morning Brew company might create a surge of optimism. Investors rush to buy shares, believing the company is more profitable than they thought. This spike in demand causes the price to rise. Conversely, if a news story breaks that Morning Brew's coffee beans are contaminated, fear and panic might set in. Investors rush to sell their shares to avoid further losses. This flood of supply causes the price to plummet. Over the long term, however, what truly drives a stock's value is the underlying performance of the business. As the legendary investor Benjamin Graham said, "In the short run, the market is a voting machine, but in the long run, it is a weighing machine." This distinction is crucial for your sanity as an investor. If you focus on the daily price movements, you will be tossed around by the waves of market sentiment. You will be tempted to buy when everyone is greedy and sell when everyone is fearful, the exact opposite of a winning strategy. But if you focus on the long-term value of the business you own a piece of, you can see the daily noise for what it is. You understand that the health of the company is what matters most. The price is just what someone is willing to pay for it today. The value is what it is truly worth over time. With thousands of stocks trading at once, how can you possibly know how the market is doing overall? This is where indices come in. A stock market index is a curated list of stocks used as a benchmark. The most famous is the S&P 500. Others include the Dow Jones Industrial Average and the Nasdaq Composite. Indices give you a simple way to measure your own performance. Indices have become investment products. You can buy an index fund or ETF that owns all the stocks in that index. One share of an S&P 500 index fund makes you a part owner in 500 companies. That gives immediate diversification and captures overall market growth without being an expert. When you own a stock, there are two primary ways you can be rewarded. The first is growth of the stock's price. That's a capital gain. The second reward is a dividend, a direct cash payment to shareholders. Younger firms reinvest. Mature firms often pay regular quarterly dividends. Together they create total return. The stock market can seem overwhelmingly complex, but successful investing often comes down to a few simple, timeless principles. The first and most important is to diversify. Don't put all your eggs in one basket. Diversification means spreading your investments across companies, industries, countries. The second rule is, think long-term. The market is notoriously volatile in the short term. The third rule, automate your investing and stay consistent. The biggest enemy of a good plan is your own emotion, fear and greed. Automatically invest a set amount every month. This is dollar cost averaging. Buy more when prices are low, fewer when high. Finally, only invest money you can leave untouched for many years. The market is not the place for your emergency fund or a near-term down payment. Follow these rules. Diversify, think long-term, stay consistent, use appropriate money, and you can build a robust strategy that weathers storms and delivers results over time. We have covered how a company goes public, how prices are set by buyers and sellers, the simple rules that can guide you. The mechanics are important, but the single most important factor in your success as an investor has nothing to do with finance. It is psychology. How you behave when things get scary. How you control your expectations when things seem too good to be true. Your mind is your greatest asset, or your biggest liability. Let's recap the core ideas. A stock is a piece of a business. The stock market is where these pieces are traded. It helps companies raise money. It lets investors share in their growth. Price is set by supply and demand, driven by emotion in the short term, driven by fundamentals in the long term. A simple plan beats a complex strategy you can't stick with. Diversify your investments. Think in decades. Invest consistently. Start learning. Get comfortable with the basics. Remember, it's a marathon, not a sprint. You don't need to check your portfolio every day or have an opinion on every headline. The world is full of financial noise. People screaming the sky is falling or shouting about the next big thing. The most valuable skill is learning to ignore them. Start small. Open a brokerage account with a small amount you can risk. Buy a low-cost index fund and watch it. Practice the art of doing nothing. Over time, your knowledge will grow and your confidence will build.